Hello everyone. Indian equity markets started the new year 2025 with a fair degree of volatility. The Nifty index declined 0.6% in the month, while the mid-cap and small-cap indices fell 6 and 10% respectively. The volatility in the markets have been on the back of a combination of global and domestic factors, including uncertainty over US policies on trade and tariff, monetary policy by the US Fed, the movement of the US dollar, and muted expectation on domestic earnings, amongst others. The first full-year budget of PM Modi's Government 3.0 was presented on 1st of February. The budget provides the right ingredients, laying the foundation to propel India to the next leg of growth, aligning with the goal of Viksit Bharat. The budget delivers on the 3 C's of supporting middle-class consumption, increase in capex through centre, state and PSU allocations, and fiscal consolidation. The key takeaway from the budget is the shift in focus towards spurring middle-class consumption. This would, in turn, provide more disposable income in the hands of the consumer. Importantly, the budget support comes at a time when consumption, especially at the bottom of the pyramid, and urban consumption were seeing muted trends, even while there have been signs of some improvement where rural demand is concerned. The budget continues to walk the path of fiscal prudence and consolidation. There have been no changes in the fiscal priorities, with the fiscal deficit being targeted at 4.4% of GDP in FY26. From FY26-27 till FY31, the target is now towards attaining a debt to GDP level of about 50% plus minus 1%. Most importantly, deregulation, ease of doing business, and employment generation have been the other key themes of the budget. Overall, we believe that all these proposals put together result in creating a virtuous circle of demand and growth. While there is a lot of debate on the capital expenditure outlay in the budget, one must remember that the capital allocation stands at 11.21 lakh crores, which is about 3.1% of GDP. Further, the budgeted capital outlay is almost 3.3 times the outlay in FY 19-20. Overall, we believe that the budget played a balancing act aimed at boosting near-term growth through gradual fiscal consolidation with focus on consumption, and at the same time laid the economic framework to boost India's medium-term growth. These policy measures would go a long way in helping seal India's position as one of the fastest growing large economies of the world. From a sectoral perspective, the top budget beneficiaries are sectors such as consumer discretionary, automobiles, and FMCG. All in all, we have seen a well-coordinated fiscal and monetary response to support growth, even while ensuring macro stability. In this context, all eyes would be on the monetary policy to be announced later in the week. Now, for equity markets post the budget, the focus would shift back to delivery of corporate earnings. The ongoing Q3 FY25 earnings season has so far been largely in line with expectations, but remember, expectations themselves have been muted. From here on, we expect Nifty to deliver single-digit earnings growth in FY25 and mid-teens earnings growth going into FY26. While Indian markets have outperformed global markets in the last 3 years, one must moderate near-term return expectations, even while the structural opportunity for Indian equities remains largely intact. The recent correction in Indian equities over the past few months has, however, resulted in large-cap valuations correcting to their long-term average levels. While mid and small-cap indices have also corrected, they continue to trade at a premium to their long-term average multiples, as well as a premium to the Nifty. And hence, from a relative valuation perspective, comfort continues to be tilted more towards large caps vis-a-vis mid and small caps. From a sectoral view, apart from discretionary consumption, we remain positive on large banks where valuations are favorable and in line with their historic average multiples. We are also positive on sectors such as technology and healthcare. The key risks to watch out for are both global and domestic. On the global front, we would need to watch out for policy changes in the US, fiscal and monetary, including tariff related measures, which could impact global growth dynamics. On the domestic front, apart from policy related measures, the key factor to watch out for would be the delivery in terms of corporate earnings. Now, with this backdrop, we would advise investors to continue to invest in equities in a disciplined manner with a long-term investment horizon, keeping in mind their asset allocation strategies as well as their risk profile and investment goals. Thank you. Stay healthy and stay invested.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.